Hello, everyone, and welcome to the Saigal Seatrade podcast. I'm Research Analyst Trisha Mohite, and I'll be your host for today's episode. So, today we are going to dive deep into the fascinating world of global shipping markets. So, today we have Mr. Sandesh Ghandat, who is an expert in commodity and shipping markets. So, thank you so much, Sandesh, for joining us today.
Thanks for having me, Trisha. It's always a pleasure to share insight with your audience. And the shipping market is at such an interesting inflection point right now, and there is a lot to unpack about where we are headed.
You're absolutely right, Sandesh. So let's start drilling down into the specific segments, beginning with the VLCCs. We know these are massive vessels that carry crude oil across our oceans. We've seen some interesting rate movements recently. So, Sandesh, could you maybe tell us what's happening in the VLCC market over the past few weeks and possibly what could be the factors that are driving these changes?
Well, Trisha, the VLCC market, it has been quite the roller coaster lately, and it perfectly illustrates how shipping is ultimately a story about supply and demand psychology as much as hard numbers. So let me take you through what's been happening. Last week started with the genuine optimism in the VLCC segment, and it was particularly for ex-MEG routes. And we see some owners, they were feeling bullish about early May loadings, and there was this palpable sense of momentum building. We have seen the rates for TD2 and TD3C routes. Those are, benchmark routes for the Middle East Gulf to key Asian destinations. They had been showing some strength. But then we saw this, kind of an interesting tactical move from the charterers. So rather than openly competing for vessels and potentially driving rates higher, they kind of started handling cargoes more discreetly. And they were essentially trying to cool the market ahead of the extended holidays in the major Asian markets like China, Japan and South Korea, where we kind of see long holidays for, these Labor Day holidays. So it's this fascinating game of chess that plays out constantly between vessel owners and charterers. Now, having said that, as the week progressed, we could feel the market psychology shifting, and with that, fewer cargoes were openly emerging, and there was this growing sense of caution, almost like everyone was holding their breath and they kind of were waiting to see which way the market would break after the holiday period. And as we move ahead further into the week, by the week's end, this kind of translate into the real numbers. When we saw TD2, it decreased by 8.11% week over week. It was concluded around world scale 67.94, and then the TD3C again similarly it fell by 9.07% to settle at world scale 66. So what's particularly interesting is how different loading regions tell different stories. So we have a XWAF route. It was a kind of relatively stable at the beginning, but it gained traction as the week went on. We actually saw XWAF East routes commanding a premium over Middle East Gulf East route on the basis of world scale index. This wasn't just about the cargo volumes. It reflected owners' preference for long haul earnings that these West African loadings offer. Then you'll look at the US Gulf loadings, which started quietly but then become increasingly bullish as the week progressed. And by the end of the week, the rates they kind of reach around $8.7 million for their kind of a benchmark route USG to China, and similarly they were around 4.1 million on a lump sum basis for USG to UK continent basis. We have seen the TD22 route, it is again the benchmark route. We saw increase over 4.7% week on week from 8.44 million to 8.84 million. And it was a swimming against the tide of what was happening in the Middle East routes. Now, this is a regional divergence tells us something important about global oil flows right now. And, when we talk about the strength in the Atlantic basin, it suggests a robust export activity. But having said that, I am also keeping a close eye on Indian PSUs, which quoted just one cargo last week. And with that, this particular cargo, it covered around world scale 83 for Middle East Gulf to West Coast India route, and Indian demand patterns can sometimes be the leading indicators for the broader Asian market. So looking ahead, I think we are set for the potential rebound. This holiday slowdown created some pause in the natural flow of fixtures, but the underlying fundamentals, they haven't changed dramatically. So post holiday, we typically see a surge in inquiry levels as businesses, they kind of return to normal operations. So with the relatively tight tonnage, specifically for the prompt dates, this could even translate into the stabilization of rates or even gain some of the modestly if the inquiry levels recover as expected. And fascinating about the VLCC market right now is how it reflects both macro oil trends and macro trading patterns. So the interplay between US exports and then the OPEC plus production decisions and the Asian demand growth, together it creates the complex matrix that kind of makes rate prediction both challenging and at the same time rewarding also.
That's incredibly insightful, Sandesh. I have to say, you've painted a vivid picture of not just what's happening in the VLCC market, but also why it's happening. And just like you mentioned about the psychological chess between the owners and the charterers, it's definitely fascinating. But now let's shift our focus to the Suezmax segment as well. So, Sandesh, could you tell us what trends are you seeing there, and maybe how do they compare to what's happening with the VLCCs?
Well, the Suezmax segment, it kind of present an equally compelling narrative, Trisha, and it was though with some distinct dynamics compared to VLCCs. But what makes the Suezmax market particularly interesting is its versatility, because these vessels, they can access a wider range of ports than the VLCCs while still offering economics of scale for substantial cargo volumes. So let's look at the ex-MEG Suezmax market first. We saw a week that started on steady footing with an interesting split in the market, with firm rates for prompt take-ins and those immediately loading windows, while early May loadings were seeing softer numbers. So this timing differential tells us something about the immediate tonnage balance versus kind of an expectation for the near future. And as the week progressed, we noticed a kind of a strengthening sentiment that was actually being pulled upward by what's happening in the VLCC segment. So this is a classic example of what we can call a spillover support in the shipping, when a strength in the one vessel segment kind of a influence in the another due to potential cargo competition or with the substitution effects. So charters sometimes look at the relative economics of splitting a VLCC cargo into two Suezmax shipments, or even in the vice versa, creating the interconnectedness between the markets. And while saying that, towards the week's end, we saw the same holiday related slowdown that affected the VLCC segment, which we already discussed. So with the fewer cargoes actively trading in the market, this keeps rates relatively stable rather than continuing the firming trend we had started to observe. Here also, what I find particularly noteworthy is the activity from the Indian PSUs. Now, Indian PSUs quoted 4 Suezmax cargoes last week, and that's a large. With the last one from MEG to East Coast India, it covered at a world scale 105. And Indian refiners, they kind of remain significant players in this space, and their tendering patterns can offer valuable insights into both pricing expectation and the regional demand. Now looking ahead to mid-May, we kind of expect a potential uptick in the rates due to improved vessel availability. However, there is a significant maintenance event planned in the CPC terminal that could reduce the cargo supply in the latter part of the month. So the CPC terminal in the Black Sea is a major export point for Kazakh and Russian crude. So any maintenance, it could have a ripple effect to the market. In short, or in the short-term trajectory for Suezmaxes, it will largely depend on the post-holiday demand patterns, and at the same time, it will also depend upon vessel availability for Suezmaxes. But the underlying fundamentals suggest a market that's reasonably balanced, with the potential for pockets of strength if cargo volumes return to the robustly after the holiday period.
That's fascinating, Sandesh. Just like you mentioned, how these different vessel classes influence each other, it's almost like an ecosystem where changes in one area ripple throughout the entire market. Now, you mentioned the Aframax segment briefly earlier. So, Sandesh, could you tell us what's happening in these segment and how does it complement with what we've discussed so far about the VLCCs and the Suezmaxes?
So you have hit on the perfect analogy with the ecosystem comparison, Trisha. The Aframax segment is indeed a vital to understanding the complete picture of the tanker market. And tanker market, I mean crude tanker market. So as this vessel, they serve both the complementary carriers to the larger classes as specialists in the certain regional trades. The Aframax market in the XMEG held relatively steady last week with firm sentiments. They kind of underpinned by strength in the Mediterranean region, and this is a perfect example of how regional dynamics in one part of the world can influence sentiment elsewhere. So even though overall activity levels remain limited in the Middle East, the tight tonnage list for early May loading supported owners' confidence. And this confidence was further bolstered by the reports of stronger rates on the ex-Red Sea East routes. And that's the Red Sea to East Asia. So these reports, they added to the market optimism, suggesting potential upside for ex-MEG East trades as well. We have one benchmark that is TD8. It's basically Middle East Gulf to Singapore. It increased by 2.09% week over week, a marginal growth. It concluded at world scale 149.71. So you know what? This kind of a rate resilience in a generally quieter market speak to the underlying tonnage tightness. And Indian PSA were also active in this segment. We saw they quote two Aframax cargoes last week, with the last one MEG to West Coast India covered at around world scale 145. So Indian demand is quite important for the tanker market perspective, specifically in the Suezmax and in the Aframax if we compare it to week on week basis. Now, having said that, let's move on to the Southeast Asia market. So Southeast Asia market is quite striking. The SEA Aframax market, it experienced a steady decline over the past week, and it was mainly driven by limited cargo activity and the oversupply of tonnage. Looking at the broader picture, these Aframax dynamics complement what we have discussed about the VLCC and Suezmax, by filling out that kind of a regional puzzle. So while VLCCs handle the major long-haul routes and Suezmax offer that versatile middle option, Aframaxes excel at serving regional trades and smaller ports, that can accommodate the larger vessels.
That's such an comprehensive view of these different tanker segments that interact and influence each other. Now, Sandesh, let's pivot to something equally important but probably often less discussed, and that is the clean petroleum products market, or as we say, the CPP market. So, could you tell us something about the LR tankers and the MRs performing and what's driving their rate movements?
Well, Trisha, the clean petroleum product market or the CPP market is indeed a fascinating space that deserves, the close attention. So it tells us so much about the global economic activity and the refining economics and consumer demand patterns. So unlike crude oil, which moves primarily from the production regions to refining centers, clean products actually move from the complex and dynamic trade route. So let's start with the LR1 segment. LR1 freight rates voyaging from XAG to Japan, it's a TC5 benchmark route. So it dwindled marginally last week, moving down from the previous week's highs of world scale 13 points to reach world scale 134.06 points. And this translates to a tangible impact on the earnings, where we saw the tanker earnings, they also took a step down and was assessed around just below $20,000 per day. And at the same time, it was down by a significant 16.33% week over week. Similarly, we have seen the LR2 segment. Here also, the rates for XAG Japan route for TC1 route, it decreased marginally by world scale 2.78 points, and they also kind of concluded on 123.33 basis points. So the earnings impact here was less dramatic compared to LR1. TC was accessed just over $26,000 per day, but they were still down by marginally $360 per day. or 1.4% week over week. Moving on to the MR segment, so these particular tankers mostly handle gasoline, diesel, and jet fuel trade. So here also the freight rates for the the benchmark TC12 route ex Sikka Japan, the cargoes actually strengthened last week, pulling up marginally by world scale 2.03 points to reach world scale 148.44. And what this translates, so this translates into the improved earnings, which are just about $13,000 per day, surging by around 100 and around $709 per day, or we can say 5.03% week over week. What's fascinating about the current market is the strategic positioning decisions being made by the vessel operators. So we have seen the MR market in the Atlantic, it kind of remains strong, and owners, they kind of increasingly opting to position vessels in the west of Suez instead of east of Suez, and they are doing the same because to capture higher earnings. So this shift has led to a significant increase in the tonnage list ex US Gulf Coast. In the US, MR freight rates, they kind of continue to rise last week despite subdued fixing activity. On the TC14 route, we have seen rates, they kind of declined significantly by 11% and was around just over $1,100,000 per day. But they kind of remained up week on week basis, and they were up by 19%, which is again kind of a significant impact in the market. So having said that, all these movements, they are ultimately tied to underlying product demand and the refinery economics. So a refinery margin surged last week across Singapore, with weekly average Dubai cracking margin at $4.68 per barrel, and it is positive since last 2-3 weeks. So the margin for the other 92 RON gasoline, it was average around $10.3 per barrel, and it was up by $2.19 per barrel, or we can say 27% growth week over week. So this improving margin incentivizes higher refinery runs, and it kind of a boost the product movements in those particular geographical locations. So talking from the US Gulf Coast point of view, we have seen the gasoline inventories domestically. It stood at around 225.54 million barrels, down 2% week over week, but still below the 5-year average of 229.97 million barrels. However, we have seen jet and kerosene stocks, it continued to build, and they were averaging around 411.48 million barrels, up by 1.08 million barrels, or 4% week over week. So all these fundamentals, from refinery operations to product inventories to refining margins, it kind of create the underlying demand patterns that drive tanker movements. And the clean product tanker market is essentially a reflection of a global consumption patterns, refinery economics, and the arbitrage opportunities between regional markets.
Sandesh, I have to say it's truly remarkable how the clean product markets reflects so many aspects of the global economy. Now, to round out our comprehensive market overview, let's also talk about the LPG market. So, could you tell us what's happening with the VLGCs and possibly how does that fit into the broader tanker market picture?
Well, the LPG market, it offers yet another fascinating window in the global energy flows, Trisha. Now, starting with the VLGC spot market, east of Suez had a somewhat subdued start to the last week, with the limited activity early on before a few fixtures materialized later. What's interesting is that despite the long position list, meaning ample vessel availability, and owners, they kind of managed to maintain rates at relatively firm levels. So you know what? This suggests underlying confidence in the market fundamentals despite the temporary slowdown. Now the fixing was largely driven by ATC, that is Atlantic Trading Company, though overall activity remained muted compared to typical levels. So the freight rates, they gradually softened to the high fees per metric ton on the Ras Tanura Chiba route by the week's end, and that's the benchmark route for these particular VLGCs. Now that's the east of Suez. So let's talk about the west of Suez. West of Suez, we have seen activity centered around early June fixing, as ex-US Gulf with 5 first decade June fixtures concluded early in the week. and they were concluded at $103, $104 per metric ton basis, Houston Chiba via Panama. This kept freight levels stable in the low hundreds per metric ton range. However, we have seen the sentiment soften slightly by the midweek as the activity they kind of tapered off with only two additional fixtures reported later on. So while the June US Gulf position list remains balanced for now, the arrival of multiple relays into the region could increase the tonnage availability, and it can apply downward pressure on the rates in the coming week. Relays, as you might know, are the vessels that have been chartered but are being sublet by the charterer, and often indication that the original charterer has released their requirements. So that's it from my side, from the perspective of LPG vessels, Trisha.
Thank you so much, Sandesh, for sharing all of your insightful expertise and your opinions with us. It was truly incredible having a discussion with you and for sharing all of your opinions with our audiences. So, thank you so much for joining us, Sandesh.
Thanks, Trisha. Thanks for inviting once again. It's pleasure to be sharing my knowledge and expertise with you guys. Thank you.
And to all our listeners, thank you so much for tuning in. Do not forget to share and subscribe to our podcast. Until next time, navigate safely and stay informed.